What if we told you there's a company really at the heart of some of the biggest, most critical global trends happening right now? We're talking everything from defending nations, powering our future with carbon-free energy, even shaping the future of, how we fly. It's often behind the scenes, maybe a name you don't see plastered everywhere, but it's absolutely indispensable. Today, we're taking a deep dive into Curtiss-Wright Corporation, that's NYSE, ticker CW. And look, this isn't just another industrial manufacturer. Our sources reveal a really fascinating story here. They're calling it a resilient growth compounder, and it's executing this powerful strategic shift, something they actually call their pivot to growth. Oh. So our mission in this deep dive is simple. Unpack that pivot to growth strategy. Explore Curtiss-Wright's critical market positions, understand its really impressive financial resilience, and see what makes it such a unique player in these really high-stakes industries. We'll be drawing from an in-depth investment analysis that gives us a detailed look, right under the hood. You can expect a journey through their diverse portfolio. We'll dissect their financial prowess from, say, 2022 to 2024. We'll also delve into the major secular tailwinds driving its business and ultimately help you understand what this all means for its long-term trajectory. So get ready for some serious insights. Okay, let's unpack this then. The report immediately labels Curtiss-Wright as a highly engineered, mission-critical technology provider. What does that really mean in practice, and how does it connect to this pivot to growth strategy they're executing? It sounds like more than just a slogan.
It really is more than a slogan. Mission critical here means exactly what it sounds like. They're providing solutions where failure is simply not an option. Absolutely cannot happen. Think about a nuclear-powered submarine operating deep underwater, right? Or an advanced fighter jet in combat. The integrity and reliability of every single component are just paramount. This aspect, the zero failure requirement, is key to their value. Now, the pivot to growth strategy, that signifies a very deliberate, comprehensive shift. They're not just maintaining their operational excellence, which frankly they're already very good at. They're actively looking to accelerate top-line expansion. And they're doing this by strategically aligning with some really powerful, durable secular trends. We're talking defense modernization, the commercial aerospace recovery post-pandemic, and crucially, the global push for carbon-free nuclear energy. It's a proactive move. They want to ensure they're not just in these markets, but growing aggressively within them.
Right, and it seems they've got the attributes to back that up. The report describes them as a high-quality compounder. Our sources specifically highlight characteristics like a defensible economic moat, that competitive advantage, also top quartile profitability within their industry, and exceptional cash flow generation. These aren't just buzzwords, are they? They point to a fundamentally strong business. For Curtiss-Wright, how is that economic moat actually built and maybe more importantly, sustained in such demanding sectors?
Yeah, that moat isn't just theoretical for them. It's very real. It's built from things like proprietary technology in their nuclear systems. It's built from the decades, literally decades it takes to get certified for critical defense programs. And it's built on these deeply entrenched relationships they have, particularly with the U.S. Navy and major aerospace OEMs like Boeing and Airbus. These aren't just small advantages. They are significant structural barriers. They create an almost unassailable market position in their niches. And that's what allows them to consistently achieve that top quartile profitability you mentioned. And the exceptional cash flow generation. Well, that's truly the lifeblood of a compounder. It gives them the flexibility to reinvest in the business, make smart acquisitions, and consistently return capital to shareholders. It creates this self-reinforcing cycle of value.
And the results, they seem to speak for themselves. That period from 2022 to 2024 in particular, our sources show some truly exceptional performance. Record-breaking sales, operating income, new orders, a growing backlog. That's a powerful surge forward.
Absolutely.
Yeah.
That performance is a clear signal that the strategy is working, right? They're effectively capitalizing on these market opportunities, hitting records across all those key metrics: sales, operating income, orders, backlog. It indicates really robust demand for what they do. And it shows highly efficient execution on their part to meet that demand. These are significant achievements, especially given, the global uncertainties we've seen recently.
What's maybe even more impressive, though, is that management achieved all of this while navigating some really significant macroeconomic challenges. We're talking persistent supply chain disruptions, inflationary pressures, things that have plagued so many industries. Yet Curtiss-Wright didn't just weather these storms. They actually expanded operating margins and aggressively invested in R&D. How did they pull that off? Expanding margins and R&D spending amidst those massive headwinds seems almost counterintuitive.
Well, it really comes down to two powerful forces, and these are hallmarks of a truly high-quality business. First, it's that undeniable mission criticality of their products we talked about. Look, when you're supplying components essential for, say, a nuclear submarine, reliability and just getting the part often trump pure cost concerns. That gives Curtiss-Wright significant pricing power. Their customers are often willing to pay for that certainty, that reliability. And second, it really highlights management's exceptional operational agility and their deep commitment to efficiency. That allow them to effectively offset rising costs and even improve profitability. This ability to defend and even expand margins in a difficult cost environment, that's a signature of a wide moat business.
So the report builds this investment thesis around three core ideas: durability of growth drivers, high quality and visibility of earnings, and disciplined capital allocation. For long-term value creation at Curtiss-Wright, why are these three pillars so profoundly important? Break that down for us.
Sure. This framework is really all about predictability, sustainability, and intelligent deployment of resources. Let's take them one by one. First, the durability of growth drivers. This means their revenue isn't subject to short-term fads or whims. Instead, they're embedded in these long-term essential government programs and industrial trends that span decades. Think naval shipbuilding, think nuclear energy. This creates a very stable demand profile. Second, the high quality and visibility of earnings. This is directly tied to their robust and growing backlog. It's like having a clear line of sight for future revenue, sometimes years, even decades in advance. That reduces earnings volatility significantly. And third, disciplined capital allocation. This is the engine that creates that self-reinforcing cycle of value creation we mentioned. They generate exceptional free cash flow, consistently exceeding 110% conversion of net income, which is truly elite territory. And this cash isn't just sitting there. It's smartly deployed into accretive acquisitions and significant share buybacks, which in turn boost earnings per share for you, the shareholder. This cycle consistently enhances value over time.
Got it. So even if the company's valuation multiples might look a bit high, maybe reflecting this premium quality, the analysis suggests this is actually justified. It's not necessarily cheap on paper, right? But that premium is earned because of the predictability of its cash flows and its strong alignment with those multi-decade growth trends we've been talking about.
Precisely. Like in the investment world, you often pay a premium for quality and predictability. It's just how it works. And when you have a company like Curtiss-Wright with such clear visibility into its future revenue streams, that consistent high margin performance, and this strategic position in industries with multi-decade tailwinds, well, that premium starts to look justified. It's about paying for that future stability and growth potential, knowing that the cash flows are reliable and tied to these deeply embedded essential global needs. It's really a reflection of the market's confidence in their ability to continue compounding value over the long term.
Okay, moving on then. That pivot to growth strategy wasn't just about buzzwords. It included a really significant strategic realignment into three core segments. This wasn't just cosmetic, was it? How was this restructuring designed to better reflect their integrated capabilities, maybe capitalize on synergies, and balance that stability with agility for resilient through-cycle performance?
Yeah, it was definitely not cosmetic. This realignment was a very deliberate structural change. It was designed to optimize their operations and their go-to-market approach. By grouping complementary businesses together, they aim to foster greater collaboration and leverage expertise across the whole enterprise. Unlock synergies that might have been kind of hidden before under the old structure. And the balancing act is crucial here. You've got the defense and nuclear businesses, which offer incredible long-term stability due to their program life cycles and government funding. That's the bedrock. Then you have the commercial aerospace and industrial segments. They might be more cyclical, sure, but they offer agility and different growth drivers. And this combination, this mix, is what truly allows for that resilient through-cycle performance. It means the company can perform strongly, hopefully, regardless of the broader economic environment at any given time.
Okay, let's dive into these three pillars then, starting with aerospace and industrial, or A&I. This segment provides precision for the skies and the ground. What's its core offering? What kind of specific products are we talking about here that make such an impact?
Well, what's really insightful about A&I is how they translate complex engineering into indispensable reliability. They're not just making, generic parts. They're designing components like ultra-precise electronic throttle controls for heavy industrial vehicles, or the advanced sensors that ensure critical flight systems operate absolutely flawlessly. It's about ensuring precision in environments where, again, failure just isn't an option, making machinery safer, more efficient. And a perfect example of the unique capabilities here is something called laser peening.
Ah, yes, laser peening. I read about that. This isn't just polishing metal, is it? It's much more advanced. It's a specialized surface treatment that actually strengthens critical airframe components without adding any weight. I mean, just imagine the implications for fuel efficiency and structural integrity in an aircraft. That's a huge deal.
It absolutely is a huge deal. Laser peening is a really advanced manufacturing process. Basically, it creates a compressive stress layer right on the surface of metals. This significantly enhances their fatigue life and resistance to things like stress corrosion cracking. The key, as you said, is that it achieves this without introducing any new material, so no added weight. And in aerospace, every single gram counts for fuel efficiency and performance, right? This technology makes components much more durable, much more reliable, extending their operational life in these really demanding environments. It's a prime example of their high-tech mission-critical focus. It literally makes the planes you fly on safer and more efficient.
And this A&I segment serves dual end markets. There's commercial aerospace, obviously benefiting from the big resurgence in air travel post-pandemic. And then there's general industrial leveraging control systems and actuation expertise for things like industrial vehicles. So next time you're flying, you can almost think about it this way. A component from this segment might very well be making your flight safer or more efficient, just operating quietly behind the scenes. Okay, next up, let's talk defense electronics. This is described as the digital backbone of modern warfare. The segment focuses on rugged, commercial, off-the-shelf, or COTS-based modular open systems architecture solutions. It's quite a mouthful. What does that actually mean for their product portfolio and its impact on, say, data processing in military applications?
Right, it is a mouthful, but the concept is important. Think of it like this. Historically, military systems were kind of like old flip phones, everything custom-built, fixed, incredibly hard and expensive to update. MOSA, that's the Modular Open Systems approach, is pushing the military towards more of a smartphone model. Standardized, modular, easy-to-upgrade components. Now, Curtiss-Wright isn't making the whole phone, so to speak. They're making the incredibly specialized military-grade internal chips and software modules, the high-value stuff that plugs into that phone. What this means for the military is faster, cheaper upgrades. What it means for Curtiss-Wright is they become an indispensable, highly profitable supplier to everyone building these advanced systems, not just one prime contractor. They provide the robust, specialized brains that empower real-time decision-making. Things like processing sensor data on an F-35 fighter jet, enabling secure tactical communications on the battlefield, or precisely aiming a turret on a ground vehicle. This is precisely why defense electronics is actually their most profitable segment. Their intellectual property, their IP, is just so valuable and incredibly difficult to replicate.
And these have broad applications, right? You mentioned the F-35 unmanned aerial vehicles, also U.S. ground vehicle modernization programs, naval defense platforms. They're truly integrated across the entire military spectrum.
Exactly. Their products are pretty much ubiquitous across defense applications because the need for robust, high-performance electronics for data processing and control is universal in modern warfare. This broad integration minimizes their reliance on any single program or platform, which gives them a degree of diversification even within the defense sector itself. And that DoD push for MOSA is truly a game changer for them. It basically carves out these high-value submarkets where their specialized high-IP COTS modules are in really high demand across numerous platforms.
Okay, our third pillar, naval and power solutions. This really sounds like a cornerstone segment for them. Provides critical technologies for the most demanding zero-failure environments imaginable. When we talk naval defense, Curtiss-Wright is actually a sole source supplier for the U.S. Navy's highest priority platforms. What kind of equipment are we talking about here? And what does being sole source mean for their revenue visibility?
Yeah, in naval and power, we are talking about literally the most critical systems on board these vessels. Any failure could be catastrophic. For naval defense, being a sole source supplier means they're the only company providing certain essential components for the U.S. Navy's most advanced nuclear-powered submarines and aircraft carriers. This includes things like the reactor coolant pumps. These are basically the heart of the nuclear propulsion system. Also power-dense motors, generators, secondary propulsion systems, and even the advanced aircraft handling and arresting systems on carriers. The gear that launches and stops multi-million-dollar fighter jets on deck. Their deep embedment in these multi-decade programs, like the Columbia-class and Virginia-class submarine programs and the Ford-class aircraft carriers, it means they have visibility on revenue streams for not just years, but multi-decades into the future. That provides an unparalleled level of stability and predictability. Very few companies have that.
And then there's the other side of this segment, commercial power and process. Here they leverage that same nuclear-grade engineering expertise, right? Providing critical valves, pumps, control systems for existing nuclear power plants. And, importantly, they're also a key technology partner for next-generation advanced reactors, including those small modular reactors, or SMRs, we keep hearing about.
Exactly. This is a direct transfer of their deep nuclear expertise, honed over decades working with the Navy. Their experience supplying the Navy's nuclear fleet makes them uniquely qualified for the commercial nuclear sector, which, as you can imagine, operates under incredibly stringent safety standards. While they provide stable, recurring revenue from supporting existing power plants, the really exciting part, I think, is their positioning in the nascent small modular reactor market. SMRs are widely seen as a key part of the future of nuclear power, smaller, potentially scalable, maybe faster to deploy. By being a key technology partner early on, embedding their tech into the designs, they're essentially getting in on the ground floor of a potentially transformative energy solution.
Okay, so why put naval applications and commercial power together in one segment? At first glance, it might seem a bit counterintuitive, right? One's military, the other's commercial.
It might seem counterintuitive, but the underlying synergy is actually fascinating. It's not really about the end customer being military or commercial. It's about the shared core competency. Both naval nuclear propulsion and commercial nuclear power demand the absolute highest reliability, long life cycle systems, and again, that zero failure performance in really harsh environments. Grouping them together fosters incredible collaboration. It allows for the seamless transfer of technology, engineering expertise, best practices between these two technically demanding domains. This cross-pollination strengthens their competitive moat and reinforces their position as leaders in extreme environment engineering. It was actually a deliberate part of that pivot to growth strategy to simplify the company's narrative and better unlock value from these crossover technologies, recognizing that the foundational engineering challenges are remarkably similar.
Interesting. Now, if you look at the financial contributions of these segments from 2022 to 2024, they really tell a story of strategic success. Naval and Power is clearly the largest revenue contributor and saw accelerating growth, going from like 3.6% in 2022 up to 12.3% in 2024. Meanwhile, Defense Electronics stands out as the most profitable, with operating margins consistently above 22%. Wow. What do these numbers directly reflect about how effectively they've executed this pivot to growth strategy?
Yeah, those numbers really illustrate the strategic strengths and the effective execution of the pivot. Naval and Power's accelerating growth, especially in the last couple of years, directly reflects the ramp-up in those huge multi-decade naval defense programs we talked about. That's a very strong, visible tailwind for them. Defense Electronics' superior operating margin consistently above 22%. That's a clear indicator of the high intellectual property content and the pricing power it commands. That's thanks to its specialized, mission-critical COTS solutions feeding into the DoD's MSUSA initiatives. And even aerospace and industrial, showing consistent revenue growth around 5–6% and improving operating margins. That shows successful navigation of the commercial aerospace recovery and real efficiency gains. The overall picture is one of balanced, profitable growth driven by distinct yet complementary market dynamics. It directly validates the strategic realignment they undertook.
And this all feeds into their overall business model resilience, which seems built on three things: a high-quality backlog, those long-term sole source contracts, and strategic diversification. That backlog, for instance, reached a record $3.9 billion in Q2 2024, up 12% just from the end of 2023. And their book-to-bill ratio is consistently above 1.0x, meaning new orders are consistently outstripping recognized revenue. Plus, it's heavily weighted towards those long-cycle, high-priority government programs like the submarines. What does that kind of forward revenue visibility actually mean for the company day to day?
Well, that record backlog and consistent book-to-bill ratio are incredibly reassuring signs. It's like looking at a full pipeline of confirmed business stretching years into the future. And much of it is largely insulated from short-term economic fluctuations because it's tied to national security priorities and critical infrastructure projects. The fact that it's heavily weighted towards government programs, especially those massive ones like the Columbia and Virginia-class submarines, gives them an extraordinary degree of revenue visibility that very, very few companies can boast. It's a massive indicator of future stability.
And those long-term sole source contracts you mentioned, it means that once a Curtiss-Wright component is designed into a platform like a submarine or an airliner, it's essentially sticky.
Hmm.
It's incredibly difficult and costly for the customer to switch suppliers later on. It sounds like once a CW component is in, it's almost part of the platform's DNA. It's not like swapping out a car tire, is it? More like trying to replace a heart in a complex machine, almost impossible to do without major disruption.
That analogy perfectly captures it. The stickiness of their products is a massive competitive advantage. The qualification and certification processes in defense, aerospace, and nuclear are so rigorous, so lengthy, and so expensive that once a component is integrated and approved, it's almost permanent for the entire life of that platform, which could be 30, 50, even 60 years. This creates extremely high switching costs for customers. It essentially locks in revenue for Curtiss-Wright for decades, and it ensures a steady stream of aftermarket service opportunities, which are often quite high margin as well. Their long-standing customer relationships, built on decades of trust, reliability, and proven performance, just further solidify that advantage.
And finally, that third element, strategic diversification. Approximately two-thirds of the business is in aerospace and defense, one-third in commercial markets. The long-term, stable, often countercyclical nature of defense and nuclear provides a buffer against the more economically sensitive commercial aerospace and industrial markets. How does this diversification help them perform consistently through various macroeconomic environments?
This strategic diversification is absolutely key to their resilience. It's textbook portfolio management, really. By not having all their eggs in one basket, they can navigate economic downturns with much greater stability. Defense and nuclear spending tends to be less correlated with the general business cycle, right? It's driven more by geopolitical realities and long-term energy policies. This acts as a counterweight to the more cyclical commercial segments like aerospace and industrial. It allows the company to maintain a more consistent performance profile overall, and importantly, continue investing in growth even when other companies might be forced to pull back during tougher times. It's a very robust and well-thought-out portfolio construction.
It really seems like Curtiss-Wright is operating right at the intersection of some incredibly powerful secular tailwinds. They're aligning themselves with these huge global priorities like modernization, electrification, and decarbonization. These aren't just fleeting trends, are they?
Not at all. These are fundamental, multi-decade shifts that are actively shaping the global economy and national priorities as we speak. Modernization in defense, for example. That's driven by evolving geopolitical threats, and fortunately, that's not going away soon. Electrification is a broad trend across multiple sectors, all aiming for greater efficiency and sustainability. And decarbonization, particularly through nuclear energy, is a critical response to climate change and the very real need for energy independence. By positioning themselves squarely at the nexus of these powerful trends, Curtiss-Wright is ensuring its relevance and, importantly, its growth potential for decades to come.
Let's specifically look at the aerospace and defense market analysis provided. Commercial aerospace is clearly in what the report calls a post-pandemic supercycle. Global air passenger traffic is projected to grow significantly, like 11.6% in 2024, and more than double over 2 decades. That drives huge demand for new, fuel-efficient aircraft and, of course, aftermarket MRO services.
Yeah, the recovery in commercial aerospace has been incredibly robust, perhaps stronger than many expected. And these projections for continued growth are powerful tailwinds. Sustained growth in air passenger traffic translates directly into a sustained need for new aircraft production, which in turn means demand for Curtiss-Wright's critical components that go into those new planes. Additionally, as airlines work hard to meet this demand, they also need to keep their existing fleets operational and efficient for longer, sometimes. And that directly fuels the higher margin aftermarket maintenance, repair, and overhaul, or MRO market, where CW also plays.
Okay, but here's an interesting dynamic mentioned. The persistent supply chain challenges that are currently constraining the major airframers like Boeing and Airbus from ramping up new aircraft production as fast as they'd like. How does a problem like supply chain constraints actually benefit a company like Curtiss-Wright? It seems counterintuitive again.
It does seem counterintuitive, but this is where Curtiss-Wright's position is actually quite unique. These supply chain constraints effectively create a dual tailwind for them. So on one hand, while it might slow down some new aircraft deliveries in the near term, the existing highly visible long-term order backlogs at Boeing and Airbus still provide a clear and sustained demand signal for CW's OEM components for those new builds. That demand isn't going away. But simultaneously, and this is the key, delayed new aircraft force airlines to extend the operational life of their existing fleets. They have to keep flying the planes they have. This directly increases demand for higher margin MRO services, such as Curtiss-Wright's specialized surface treatments like that laser peening we discussed. So whether new planes are being built or older ones are being kept flying longer, CW benefits. It provides a surprising layer of resilience in the current environment.
Okay, fascinating. And then there's global defense spending, a clear modernization imperative underway. The geopolitical environment is described as highly favorable, driving elevated defense budgets pretty much everywhere. The U.S. DoD budget request for fiscal year 2025, for example, is a robust $850 billion.
Yeah, unfortunately, geopolitical realities are undeniable drivers here.
Yeah.
Elevated defense budgets globally are a direct response to strategic competition and instability around the world. The U.S. DoD's $850 billion request for FY25 signals a sustained commitment to defense spending, which directly supports Curtiss-Wright's defense segments. But it's not just about the big headline number, though. It's really about the strategic allocation within that budget.
Right, exactly. It's about strategic allocation. Spending is focused on modernization and achieving technological superiority. Things like shipbuilding, especially submarines, advanced munitions, R&D for next-gen capabilities like unmanned systems and hypersonics, and critically, upgrading existing platforms with advanced electronics. All of this seems directly aligned with Curtiss-Wright's portfolio.
Absolutely. The strategic allocation of those defense dollars is precisely where Curtiss-Wright thrives. They aren't trying to build the entire ship or plane. They are embedded in the highest priority, longest-term programs where the technology really matters. Whether it's the complex electronics needed for next-generation unmanned systems or the critical components for new nuclear submarines, CW's offerings are essential to the DoD's modernization goals. They aren't competing for every single defense contract out there. They're specializing in the parts of the budget that demand cutting-edge technology and that zero-failure reliability. That ensures their continued relevance and growth in this vital sector.
Okay, let's shift gears now to the commercial power and industrial markets. The global nuclear renaissance is a huge story here. It's driven by those dual needs: carbon-free energy to combat climate change and energy independence for national security. This market is projected to grow at a decent clip, 3.4% CAGR, to over $26 billion by 2030.
Yes, the nuclear renaissance is a significant long-term trend gaining real momentum. Concerns over climate change and, frankly, the volatile nature of global energy markets have put nuclear power firmly back in the spotlight. People are recognizing it again as a reliable, carbon-free baseload energy source. And this isn't just political talk anymore. It's driving real investment worldwide. That creates a substantial growth market for critical components and services, exactly like those Curtiss-Wright provides. And that growth comes from two forces: extending the life and modernizing existing reactors, and significant investment in new builds, including both large-scale reactors and those next-generation SMRs.
Right, the SMRs. So the company is actively securing strategic partnerships with leading SMR developers like Rolls-Royce, SMR, TerraPower, Westinghouse. What does this proactive positioning mean for their future growth, especially given the promise of SMRs for, more scalable, potentially faster, maybe more cost-effective nuclear capacity?
Look, by embedding their critical technologies, we're talking control systems, specialized pumps, things like that, into the foundational designs of these next-generation reactors. Okay, Curtiss-Wright is essentially creating a powerful, embedded call option on the future of nuclear energy. That's a great way to think about it. SMRs represent a potential paradigm shift, right? Moving towards factory-built, standardized, more rapidly deployable nuclear units. As SMRs transition from development, which is where many are now, to actual global deployment over the coming decades. Well, CW is positioned to be a sole source or key supplier on numerous platforms. This could potentially create an entirely new growth vector for them, one that might eventually rival the scale and duration of their existing naval defense business. That's a huge long-term opportunity for you, the investor, as it positions them at the very forefront of a generational transformation in energy production.
And we shouldn't forget industrial automation either. That market is projected to grow at a strong rate, nearly 11% Billy GAR, to over $378 billion by 2030, fueled by things like Industry 4.0, labor shortages driving automation, and just a general focus on productivity and efficiency. That seems like a steady tailwind for Curtiss-Wright's industrial vehicle and automation products, too.
Definitely. The industrial automation trend is pervasive. It's touching almost every manufacturing and logistics sector globally. Companies are relentlessly pursuing efficiency gains and trying to address persistent labor challenges through automation. Curtiss-Wright's expertise in control systems, sensors, and actuation for industrial vehicles and factory automation solutions directly benefits from this ongoing strong demand for increased productivity and smarter manufacturing. It's another solid long-term tailwind.
Okay, so all of this points to a really defensible competitive moat and market position for Curtiss-Wright. They aim to be an indispensable niche leader, right? Management's goal is explicitly stated as being #1 or #2 market share in their key end markets. And they do that by providing these highly engineered, high IP solutions for critical applications where not just anyone can compete.
That focus strategy is absolutely key to their success. They don't try to be everything to everyone, which is a trap many companies fall into. Instead, they concentrate on being the absolute best in these specialized high-value niches, where their technological superiority and their intellectual property create significant barriers to entry for any potential competitors. This focus allows them to maintain strong pricing power and achieve those superior profitability margins we discussed. And these aren't just minor barriers, they're formidable fortress walls. The regulatory hurdles alone in nuclear defense and aerospace are immense. It can cost years and millions, even hundreds of millions of dollars just to get qualified. And once a component is qualified and designed into a platform that's going to operate for 30, 50, maybe even 60 years, well, it's virtually impossible to switch suppliers due to the recertification costs and the operational risks involved. This creates a deeply entrenched market position and a recurring revenue stream that is highly predictable and incredibly difficult for new entrants to challenge.
So just to be clear, Curtiss-Wright isn't out there competing for those huge, often lower margin platform integration contracts like building the whole submarine or the whole airplane. Instead, it focuses on dominating the supply of these niche, often sole source subsystems, commanding pricing power because of its technological superiority and protected IP. This focus, combined with that segment diversification, seems to provide a unique kind of through-cycle resilience.
That's exactly right. This focused competitive advantage is fundamental to their high-quality compounder status. They're not just chasing volume for the sake of it. They're incredibly strategic about where they choose to play, ensuring they hold a dominant position in these high-value, high-IP subsegments. This allows them to avoid the intense margin pressures often seen in broader system integration markets and instead capitalize fully on their specialized expertise. And this focus, combined with their segment diversification across defense, aerospace, power, and industrial, it means they are remarkably resilient across different economic cycles, consistently delivering strong performance.
All right, let's turn to Curtiss-Wright's financial performance now. It truly tells a story of margin expansion and really strong cash generation. Looking at revenue and profitability from 2022 to 2024, they've shown accelerating top-line growth. Revenue went from modest growth in 2022 to double digits in 2023, then nearly 10% in 2024, reaching a record $3.12 billion. And that momentum apparently continued into the current fiscal year, with strong sales growth reported in Q1 and Q2 as well.
That accelerating top-line growth is direct validation of their pivot to growth strategy working in practice. It's not just theory. It clearly shows that their efforts to align with those strong secular tailwinds and optimize their portfolio are translating into tangible revenue expansion. The sustained strong growth rates indicate robust demand across their key markets and really effective execution in capturing that demand. It's a very positive trajectory for the company's top line.
What's arguably even more impressive, though, is their margin expansion during this period. Despite all the global inflation and supply chain stress, which squeezed so many companies, their adjusted operating margin actually improved consistently from 17.3% in 2022 to 17.5% in 2024. And management is guiding for another 100 to 120 basis points of margin expansion for the current fiscal year, pushing that adjusted operating margin potentially above 18.5%. How did they manage that? Expanding margins during such a challenging period of inflation when almost everyone else was struggling with rising costs.
Yeah, it's quite remarkable, and it's a powerful testament to, again, their pricing power, the mission-critical nature of their products, and the tangible benefits of their relentless operational excellence initiatives. When your products are truly indispensable, customers are often willing to accept price adjustments to ensure supply reliability. You just have to have the part. This demonstrates that Curtiss-Wright's value proposition is incredibly strong, allowing them to pass on increased costs effectively, unlike many others. Furthermore, their continuous focus on efficiency, things like lean manufacturing, supply chain rationalization, which is deeply embedded in their company culture, has clearly enabled them to offset inflationary pressures and actually improve their profitability. This ability to defend and expand margins in a difficult cost environment is, as I said before, a real hallmark of a wide-moat business.
And this operational leverage, it translated directly to the bottom line, didn't it? Adjusted diluted EPS grew 16% in 2024. And the guidance for the current fiscal year is for another 16% to 19% increase. That's significant compounding.
It is.
This consistent double-digit EPS growth is exactly what you want to see from a high-quality compounder. It reflects the combined impact of their strong revenue growth, that impressive margin expansion, and the strategic use of capital to reduce the share count through buybacks. This consistent earnings growth clearly demonstrates their ability to deliver tangible value directly back to shareholders year after year.
Their return and cash flow profile also look really strong in the analysis. Return on invested capital, ROIC, improved consistently from 11.3% to 12.5%. But the real hallmark, the truly exceptional part highlighted, is their free cash flow FCF conversion. It's consistently well above 100% of net income, hitting 114% in 2023, 116% in 2024, and expected to remain over 105%. Why is that specific metric so important?
That elite level of cash generation, that FCF conversion to over 100%. It isn't just a financial metric on a spreadsheet, it's a strategic weapon for them. Free cash flow conversion consistently above 100% basically means that for every dollar of reported accounting profit, net income, they're generating more than a dollar in actual cold, hard cash. The predictability of these strong cash flows, anchored by that huge long-cycle backlog we discussed, provides management with immense confidence and flexibility. It allows them to consistently execute their balanced capital allocation strategy, reinvesting in the business organically, pursuing strategic M&A, and returning significant capital to shareholders through buybacks and dividends, all without stressing the balance sheet. While many competitors might struggle and have to retrench during periods of economic uncertainty, Curtiss-Wright's powerful FCF engine allows it to keep investing, keep acquiring, and keep strengthening its long-term competitive position, fueling future growth. It's a massive advantage.
And underpinning all of this financial strength is their balance sheet fortitude. The report describes it as strong and flexible. Their key leverage ratio, total debt to EBITDA, actually declined from 2.34x in 2022 down to a very conservative 1.65x by the end of 2024. And that's even while making acquisitions. Plus, they apparently had about $2.5 billion of borrowing capacity, or dry powder, available at the end of 2024 for future strategic initiatives.
Exactly. A strong balance sheet is foundational for any company, but it's especially critical for one pursuing an acquisitive growth strategy like Curtiss-Wright. Their ability to actually reduce leverage while still making strategic acquisitions demonstrates exceptional financial discipline and the sheer strength of their cash generation. And that $2.5 billion in available borrowing capacity, that dry powder, provides immense flexibility for future growth opportunities. It allows them to potentially pounce on attractive, value-accretive M&A targets when they arise, without being constrained financially.
Okay, now let's zoom back in on the heart of their current strategy, the pivot to growth. CEO Lynn M. Bamford, who took the helm back in January 2021, really initiated this vision. The report describes it as a shift from primarily focusing on operational excellence, which they were already good at, to a more balanced approach that explicitly prioritizes accelerating top-line growth. This wasn't just a slogan, right? It was presented as a fundamental change, visible in explicit long-term targets, an increased pace of M&A, and accelerated R&D spending.
That's a very accurate summary. Lynn Bamford's leadership marked a clear strategic evolution for the company. While operational excellence absolutely remains a core strength and focus, the pivot to growth explicitly signals an outward-looking, proactive pursuit of market expansion. It's a fundamental recalibration of priorities, really embedding growth acceleration into the company's DNA through clear, measurable targets that they hold themselves accountable to. And as you said, this isn't just some vague aspiration. It's backed by tangible actions, increased investment in R&D, and a more assertive, yet still very disciplined, M&A strategy. It's all designed to leverage their existing strengths into new growth vectors. It really underscores a proactive approach to shaping their own future, rather than just reacting to market conditions.
And they've identified 4 key organic growth levers, or secular trends, that are expected to drive this sustained growth for years to come. Let's tick through them. First, naval shipbuilding. That multi-decade acceleration to recapitalize global fleets, particularly the U.S. Navy, to counter adversaries. Curtiss-Wright's sole source positions on the Navy's highest priority platforms, especially the Columbia-class submarine, provide a long, visible runway for growth here.
Yes, this is absolutely a foundational growth driver for them. The need to modernize and expand naval fleets globally, and particularly for the U.S. Navy, is a multi-decade imperative driven by geopolitics.
Curtiss-Wright's deep embedment as a sole source supplier on critical, long-life programs like the Columbia-class submarines means they're not just participating in this trend, they're an indispensable part of it. This provides that almost unparalleled level of long-term revenue visibility we keep coming back to, essentially guaranteeing sustained demand for their specialized products for many, many years to come.
Okay, second driver. Battlefield technology. The increasing complexity of the modern battlefield drives demand for advanced electronics, embedded computing, secure communications. Modernization efforts and next-gen systems require ever more data processing power and capability.
Right. Modern warfare is increasingly reliant on data, sensors, network systems, and secure communications. It's becoming incredibly complex. As technology advances and threats evolve, the need for cutting-edge electronics and sophisticated embedded computing solutions just intensifies year after year. Curtiss-Wright's defense electronics segment is perfectly positioned to capitalize on this, providing that digital nervous system for next-generation platforms and crucial upgrades to existing ones. This is a continuous cycle of innovation and demand driving growth.
Third, carbon-free energy and energy independence. We've touched on this a lot. The global push for decarbonization and energy security is driving that nuclear power resurgence. Curtiss-Wright is a critical supplier for existing reactors and a key partner for those future SMRs, representing a massive long-term growth opportunity.
Absolutely. This vector highlights their dual benefit from the nuclear renaissance. They support the existing fleet, which provides stable recurring revenue and cash flow today, while simultaneously they're investing strategically in the future with SMRs. The long-term societal need for reliable, carbon-free baseload power, combined with national security interests and energy independence, ensures this is a durable and expanding market for their unique nuclear expertise.
And finally, the fourth organic growth lever, electrification. This trend is extending across air, land, and sea platforms now. Curtiss-Wright is leveraging its expertise in things like power-dense motors, advanced controls, and electromechanical actuation for applications ranging from industrial vehicles to potentially emerging advanced air mobility markets.
Electrification is truly a cross-cutting trend, impacting so many sectors. And Curtiss-Wright's deep engineering expertise in power conversion, high-performance motors, and precision controls positions them perfectly to benefit. Whether it's making industrial vehicles more efficient or enabling the exciting potential of things like electric vertical takeoff and landing aircraft eVTOLs in advanced air mobility, their technologies are fundamental to enabling these next-generation electric platforms. It's a broad and expansive growth opportunity for them.
Now, acquisitions are also explicitly called out as a core pillar of their pivot to growth strategy. They're designed to supplement that organic growth by adding critical adjacent technologies. But they have a disciplined framework, right? Targeting businesses with unique IP, high barriers to entry, clear synergies, and importantly, a key financial guardrail. Purchase price at or below 12x next 12 months EBITDA to ensure the deals are value accretive.
Yes, that disciplined M&A framework is absolutely crucial. It ensures that acquisitions aren't just pursued for the sake of getting bigger, but are strategically sound, financially accretive, and actually enhance their competitive moat. By focusing on businesses with unique IP and those high barriers to entry, they're not just buying revenue streams. They're acquiring enduring technological capabilities that strengthen their overall portfolio and their intellectual capital base. And that financial guardrail, keeping the purchase price at or below 12 times forward EBITDA, provides a clear benchmark for making smart, shareholder-friendly deals that don't overpay. The acquisition of Ultra Energy in late 2024 is cited as a perfect illustration of this strategy in action. Ultra Energy is a leader in reactor protection systems for commercial nuclear. It was a perfect strategic fit, bolstering their carbon-free energy pillar, expanding their portfolio for existing plants, and strengthening their positioning for new SMR designs. It ticks all the boxes.
And to maintain all this technological leadership and fuel future organic growth, Curtiss-Wright is committed to growing its R&D investment faster than its sales growth. This investment is strategically focused on the highest growth opportunities and managed through something called a collaborative innovation platform.
That commitment to outpace sales growth with R&D investment is a very strong signal of their long-term vision. It clearly shows they're not content to just rest on their existing technology base, but are actively investing to maintain their competitive edge and develop the solutions needed for tomorrow's demanding markets. The collaborative innovation platform mentioned is designed to leverage expertise from across the entire company, ensuring that their R&D efforts are efficient, targeted, and impactful in addressing future customer needs and unlocking new growth opportunities. It's about smart innovation,
Okay, so Curtiss-Wright's robust and predictable cash flow generation enables this really disciplined and shareholder-friendly capital allocation framework. It creates that self-reinforcing cycle we talked about. Strong FCF funds, strategic acquisitions that accelerate growth, which then generates even more FCF for shareholder returns, mostly buybacks, ultimately driving EPS growth.
Exactly. This self-reinforcing cycle is really the epitome of what you look for in a high-quality compounder. It's a virtuous loop. Financial strength generates growth opportunities, which in turn generate more financial strength. The predictability of their free cash flow is the absolute engine here. It allows management to confidently reinvest in the business, make those strategic acquisitions, and return significant capital to shareholders, all in a balanced way that consistently grows earnings per share over time. It's a well-oiled machine designed for long-term value creation.
And they have very clearly stated priorities and even ambitious long-term financial targets out to 2026. Priorities are 1. Reinvest in organic growth, CapEx, R&D. 2. Strategic, value-creating M&A. 3. Return excess capital to shareholders, primarily share repurchases plus a growing dividend. And the targets include things like organic revenue CGR over 5%, operating income growing faster than revenue, meaning margin expansion, top quartile margin performance, adjusted EPS GR over 10%, and average FCF conversion staying above 105%.
Those are indeed ambitious, yet, based on their track record and market positioning, quite achievable long-term targets. They reflect management's confidence in their strategy and execution capabilities. The clear prioritization of capital allocation organic growth first, then M&A, then shareholder returns shows a very prudent, value-oriented approach. They're not just chasing acquisitions at any cost. These targets, particularly the double-digit EPS growth target and that elite FCF conversion target, provide investors with a tangible roadmap. It shows how they intend to continue compounding shareholder value over the next few years. It gives you, the listener, a very clear set of metrics to track their progress against.
Speaking of shareholder returns, they do have a solid track record there. 8 consecutive years of dividend growth as of 2024, with a recent 14% increase. Though the report notes the payout ratio is low and the yield is modest. Their primary vehicle for returning capital is actually share repurchases. They bought back a record $350 million in 2022, another $250 million in 2024, and the board keeps authorizing increases, signaling continued commitment. This is a significant contributor to that double-digit EPS growth, isn't it?
Absolutely. Share repurchases are a highly effective and often tax-efficient way to return capital to shareholders, especially for a company generating such strong and consistent free cash flow like Curtiss-Wright. By systematically reducing the number of outstanding shares, they automatically boost earnings per share even if net income stays flat. It's financial engineering that directly benefits existing shareholders. The consistent authorization and execution of these large buyback programs demonstrate management's strong commitment to enhancing shareholder value and also signals their belief that the stock itself represents a good long-term investment at current levels.
Now, the successful execution of this whole strategy is obviously a direct result of its highly experienced and disciplined management team, especially CEO Lynn M. Bamford, and what sounds like a deeply ingrained culture of operational excellence. Lynn Bamford, a company veteran since 2004 who previously led the defense and power segments, has really defined her tenure since taking over as CEO in 2021 with the successful rollout of this pivot to growth and those record financial results. What stands out to you most about this leadership team? It sounds like they're really threading a needle that many companies struggle with, balancing efficiency and growth.
What truly stands out to me is their rare ability to simultaneously drive near-term operational efficiency and make those crucial long-term strategic growth investments. That's a hard balance to strike. Many companies excel at one or the other. Either they're great operators squeezing out costs, or they're visionary investors betting on the future. But they often struggle to do both effectively at the same time. Curtiss-Wright's leadership, particularly under Lynn Bamford, has successfully delivered on both fronts. You see it in the consistent adjusted operating margin expansion, even during a challenging inflationary period. While at the same time, they've been accelerating R&D spending and executing disciplined strategic M&A. This dual focus on both efficiency and strategic growth is a key attribute of a high-quality compounder. It demonstrates exceptional strategic foresight and top-notch execution capability.
And this focus feeds right into their core principle of driving efficiency and the quality of their earnings. Operational excellence isn't just a goal. It's described as a core tenet of their culture and a primary contributor to that margin expansion through initiatives like lean manufacturing and supply chain rationalization.
Exactly. These initiatives aren't just isolated projects they do now and then. They seem to be deeply embedded in the company's DNA, part of how they operate every day.
Operational excellence, pursued through things like lean manufacturing principles and continuous supply chain optimization, is what allows them to consistently expand margins even when facing cost pressures from the outside. That innovation cooperative mentioned in the nuclear business, for instance, sounds like a great example of a proactive approach turning internal efficiency efforts into a customer-centric product development process that benefits everyone. It's a continuous pursuit of improvement that directly translates into higher profitability and a stronger competitive advantage.
And related to that, the quality of Curtiss-Wright's earnings is highlighted as exceptionally high. That consistent free cash flow generation, remember, greater than 100% of net income, means the reported earnings aren't just numbers on paper. They're backed by real, tangible cash flowing into the company.
High quality of earnings is absolutely paramount for long-term investors. It means that the financial statements accurately reflect the true economic performance and underlying health of the business. When free cash flow consistently exceeds reported net income, it gives you confidence that the company's earnings are not being artificially inflated by aggressive accounting choices, but are robust, real, and liquid. This provides immense confidence in management's ability to fund their growth strategies, pay dividends, and conduct those share buybacks without needing to rely heavily on external financing or stretching the balance sheet. It's a very, very attractive trait for you as a long-term investor.
Okay, now let's turn to valuation analysis. This is always tricky. How do we price such a high-quality industrial company? Following significant appreciation in its stock price over 55% in the past year leading up to mid-2024, Curtiss-Wright's valuation multiples have naturally expanded. Its PE ratio was around 41x at that time, well above historical norms. This definitely reflects the market finally recognizing their successful execution, that improved growth profile, and the high visibility of their future earnings.
Yes, the market has clearly woken up to their strong performance and the success of their pivot to growth strategy. That's undeniable. Significant stock price appreciation and expanded multiples like that are typically a sign that investors are now willing to pay a premium for a company demonstrating such a clear growth trajectory combined with robust financials and critical market positioning. It often indicates a fundamental re-rating of the company's prospects by the market.
But the report cautions that a simple PE comparison can be misleading without considering the underlying business quality. When benchmarked against a peer group of other high-quality aerospace, defense, and industrial companies, names like Helmet, Moog, Parker-Hannifin, RTX, Teledyne, Textron, HII, BWXT, Curtiss-Wright's premium valuation starts to appear more rational, doesn't it?
It does. A simple PE comparison in isolation can indeed be misleading, especially across different industries or companies with varying quality profiles. Curtiss-Wright's premium valuation seems more rational when you adjust for its superior quality metrics relative to many peers. We're talking top quartile operating margins, strong and improving return on invested capital, and that elite free cash flow generation. The analysis suggests it occupies a compelling middle ground, offering a desirable blend of strong, visible growth and top-tier profitability. That combination often justifies a premium valuation over peers that might be more specialized, more cyclical, or less profitable. They've arguably earned that higher valuation through consistent, superior execution over time.
So, for digging deeper into intrinsic value, a discounted cash flow or DCF analysis seems well suited here. That's because of the high visibility into their future cash flows, thanks again to that substantial and growing backlog. And the report also suggests a sum of the parts, or SOTP, analysis could potentially reveal additional hidden value. For instance, you could argue defense electronics, with its high-margin, high-growth profile, should maybe be valued more like a high-end technology or software company. While naval and power, with its incredibly long cycle, almost utility-like cash flows from those sole-source government programs might warrant a lower multiple, but also a lower discount rate due to its lower perceived risk. This granular approach, looking at the pieces individually, could really unlock a deeper understanding of the company's total value, couldn't it? Almost a ha-ha moment.
It absolutely could. An SOTP analysis allows you, the analyst or investor, to appreciate the distinct value propositions embedded within each individual segment, which might get lost in a consolidated view. Defense electronics, with its strong IP focus and its key position within the DoD's MOSA framework, truly does possess characteristics akin to a high-growth, high-margin tech company. That could justify a significantly higher multiple than the overall company average. Naval and power, on the other hand, offers almost unparalleled utility-like predictability with its multi-decade sole-source government contracts. Lower growth, perhaps, but incredibly low risk, potentially warranting a lower discount rate in a DCF.
By breaking the company down into these constituent parts, you might indeed find that the market isn't fully recognizing the distinct, superior qualities of each piece within the larger Curtiss-Wright whole. It highlights the potential depth of value embedded in the business that might not be obvious from just looking at the consolidated multiples.
So putting it all together in a valuation synthesis, Curtiss-Wright is portrayed as best-in-class operator, one that has earned its premium valuation through superior execution, a highly resilient business model, and clear alignment with durable secular growth trends. The key question isn't really if it's cheap on a simple metric basis, but rather if its high-quality attributes and consistent performance can allow it to grow into its current valuation over time and continue compounding shareholder value. And the evidence presented from the backlog, the end markets, the cash generation, the disciplined capital allocation strongly suggests that it can. It truly represents, according to this analysis, a compelling opportunity for long-term investors seeking a high-quality industrial growth compounder. Okay, but no analysis is complete without looking at the potential downsides. It's essential to consider the potential risks that could impact performance. Let's look at cyclical and market risks first. Around 48% of their revenue in 2024 was tied to U.S. defense programs. That means shifts in congressional priorities, budget reductions, or specific program cancellations are material risks, right?
Yes, that direct dependence on government spending, particularly the U.S. defense budget, is indeed a primary risk factor. It's inherent in the business model. While defense budgets have been robust lately due to the geopolitical climate, political shifts, changes in administration priorities, or unexpected budget cuts driven by fiscal concerns could certainly impact their defense segments significantly. It's a risk inherent in the defense contracting business, which is precisely why their diversification into commercial markets and their focus on long-term, high-priority programs are so important as mitigating factors.
And their commercial, aerospace, and general industrial businesses, while providing diversification, are inherently exposed to broader economic cycles. A global recession could reduce air travel, hitting demand for new aircraft and MRO. It could also dampen industrial activity, affecting their industrial segment. Plus, even with that strong backlog, the report notes that government contracts can sometimes be modified or even terminated for the government's convenience, and commercial orders can potentially be canceled or deferred if economic conditions worsen significantly.
Those are absolutely valid points to consider. While the defense and nuclear segments provide a strong element of stability, the commercial parts of the business are undoubtedly sensitive to economic downturns. That's the cyclical nature of those markets. And while a strong backlog is a huge asset, it's not an ironclad guarantee. Government contracts often contain clauses allowing for termination or modification, although usually for major reasons on critical programs. And commercial clients can, and sometimes do, alter their plans based on their own business conditions. These are factors that Curtiss-Wright's management constantly monitors and works to mitigate through robust contract management, close customer relationships, and maintaining operational flexibility. But the risk remains.
Okay, what about operational and execution risks? Things like supply chain issues and input costs must still be a concern. They rely on a global network of suppliers, so component shortages or price volatility for raw materials could potentially compress margins, despite their recent success in managing this. And while M&A is a key part of the growth strategy, acquisition integration always carries execution risk failure to integrate smoothly, achieve expected synergies, or retain key personnel from the acquired company.
Yes, supply chain resilience is a continuous challenge for all complex manufacturers today, and Curtiss-Wright is certainly not exempt. Any significant disruption, whether it's component shortages or logistics bottlenecks, could impact their production schedules and potentially their costs. Similarly, while their M&A strategy appears very disciplined on paper, integrating new businesses successfully requires significant management attention and effort. There's always a risk that the expected synergies don't fully materialize or that cultural integration proves difficult. These are operational realities that strong management teams plan for and actively manage, but the risks are always present.
And in these dynamic, highly competitive markets they operate in, there's always the risk of falling behind technologically. Failing to innovate, develop new products that meet evolving customer needs, or effectively protect their valuable intellectual property could, over time, erode their competitive advantages.
Absolutely. Innovation is a race without a finish line, especially in technologically advanced sectors like aerospace, defense, and advanced electronics. Staying ahead requires continuous, significant investment in R&D and the ability to effectively protect their valuable IP from competitors. A failure on either front could allow competitors to catch up or leapfrog them in key areas, diminishing their competitive moat over the long term.
This is precisely why their accelerated R&D investment under the pivot to growth strategy is so critically important.
Finally, let's touch on regulatory and compliance risks. As a major U.S. government contractor, they're subject to complex and constantly evolving procurement rules and regulations. Non-compliance could potentially result in fines, penalties, or even, in extreme cases, debarment from government contracts. With a significant portion of sales coming from outside the U.S., around 27%, they're also exposed to geopolitical risks, changing trade agreements, tariffs, and currency fluctuations, and, of course, their nuclear operations operate under extremely stringent environmental, health, and safety regulations.
These regulatory and compliance risks are definitely non-trivial, particularly in highly regulated industries like defense contracting and nuclear power. The cost of compliance is significant, and the penalties for non-compliance can be severe. Operating internationally also introduces that additional layer of complexity arising from geopolitical tensions, trade disputes, and foreign exchange volatility, which can impact reported earnings. Strong internal controls, a robust ethics and compliance framework, and experienced legal and regulatory teams are absolutely essential to navigate these complex challenges effectively and avoid significant liabilities. It's a constant balancing act for management between operational execution and strict adherence to a complex global web of rules and regulations.
Well, we have certainly taken a deep dive into Curtiss-Wright today. It's a company that truly stands at the crossroads of some of our most critical global needs, doesn't it? From its unique three-segment structure and that powerful pivot to growth strategy to its exceptional financial performance, especially that cash flow generation and the disciplined leadership driving it all. We've seen clearly why it's considered a high-quality compounder by the analysts we reviewed. It's really a story of resilience, sustained innovation, and sharp strategic positioning in demanding markets where, as you said, failure is simply not an option. Now, beyond the impressive financials and the smart strategic moves, we want to leave you with a final thought to consider. How does a company like Curtiss-Wright, so deeply embedded in critical national infrastructure, everything from defense and security to the fundamental shift towards carbon-free energy, how does it shape not just its own future, but the very fabric of our world? How will that nascent small modular reactor market truly transform the global energy landscape over the next few decades? And what enduring role will a specialized critical supplier like Curtiss-Wright play in that potentially generational transformation? What stands out to you most about the long-term implications of these foundational technologies they're involved in? Something to think about.